Hello and welcome to a brand new show of Market Makers. What a year of extraordinary twists and turns it's been for Indian markets. We started the year on a high note, then came the big tsunami. Financial media started using words like mid-cap rout and financial Armageddon rather loosely, and then came the great recovery. Nifty at an all-time high. The ring of that is beautiful, but somehow you can see the bull market, you cannot feel the bull market. Why are markets so divided? Where do we go from here? And let's not forget the political overhang which will have impact on markets in next 6 to 12 months. So it's quite, I won't use the word hazy, but it's a challenging time. How does one invest and make money in this challenging time? What about fundamentals and macros? So discuss all that and much more. I have with me the perfect guest, Surendra Goyal of Citi India Research. Surendra, fantastic to have you back. Thank you for joining us.
Thanks.
Just been one of those crazy years, and we can argue both ways. If you're a bull, you would say Nifty at an all-time high. If you're a bear, you would say ruk ja bhai, mid-cap index niche. So you can argue both ways, I guess.
Yeah, absolutely. First of all, thanks for having me on the show. So yeah, it's been a very interesting year, and not only mid caps and large caps, it totally depends on which currency are you looking at returns in, right? If you are looking at dollar returns, practically no returns this year, right? Obviously, rupee returns have been great, but I think the more important thing is India has really been an outperformer in the EM space. And that I think is a fact. Like if you see all the data, India has been the best market, or at least among the larger markets. And I think what is really helping is firstly, we had very strong domestic flows through the year and they continue, and which has always been a support for the market. And on top of that, in the last month or so, we have seen some foreign flows starting to come back as some of the EM investors are more concerned about what's happening in the other major EM markets. So a combination of that has really kind of set India in a sweet spot over the last month, which is where we have seen a lot of this full year returns come through.
Is this positioning or the sweet spot which you say, is this temporary in nature, or this is more like a structural change towards India because others are losing out?
No, so this India has always been a good market for foreign investors. Okay, but this what I'm talking of is more of a short-term thing, and again it depends on how global issues pan out. Could become a medium-term thing depending on how things get resolved. But at this point, it does look like it's people trying to find a safe place to be in. Okay, and if tomorrow some of the trade war related issues, if they get resolved in some manner, then you could actually see the flow, this part of the flow reverse. And which is why I'm saying this part is more short-term in nature. But yeah, generally, if you see over the last many years, India has always been a well-liked market. That will continue.
In your latest strategy report, you've not changed your Sensex target for March 2019. And your March target for Sensex is lower than where the markets currently are, which means you expect markets to come down in the next 6 months?
Yeah. So let me put it this way. I think while we have liked the market and the earnings recovery story for a while, it's just that the market has really outperformed emerging markets by a very, very significant amount. And if you see the premium to EM earnings or multiples, it's now at 70% plus, which is almost the highest in 10 years. And if you see last couple of times when we hit this kind of 60-70% levels, over the next year and a half, the multiple, the premium came down to 30%. Okay, so in some ways India underperformed meaningfully. So that's one thing to keep in mind, that valuations are on the higher side. Secondly, the earnings recovery, a large part of it, incremental earnings, if you see FY19, half of the incremental earnings are supposed to come or expected to come from financials. Now, those have been volatile, and I think one needs to monitor if they actually come through, because earnings recovery has been a theme for 5 years now, right? And first 4 years it has disappointed. So that's also something which I would really keep in mind. And the third thing is, if you see the top down and the market, it's not like very easy to correlate. Okay, and I was talking to some people in our fixed income team. Okay, and again they were joking that we are like living in two different markets, because on one hand, the macro, if you see the current account, if you see the rupee, okay, if you see the fact that globally things are in a flux, crude is still an overhang. If you put it all together, and then you have, as you pointed out, political elections coming up in the later part of the year, you put it all together, the top down is not really as great. So when you kind of put all those 3-4 things together, our view was that at least in the short term, it does look like that the market is running a little ahead of fundamentals. So while we have liked the market, we have liked the earnings recovery theme, at this point we are comfortable with the target that we have.
Now you made a very interesting point that Indian valuations are at almost 10-year high. There is 70% premium. So when did this happen last time and what happened after that?
Yeah. So 70% was almost exactly 10 years back. It was 2007-8 kind of a time frame, right? So now again, it could happen because of different reasons. At that time, India was really doing well and expectations were running very high. Okay, and then when those expectations didn't play out, and then you saw the market correcting, right? Right now, I think it's a different kind of a thing where yes, expectations are high, but at the same time, people are trying to hide in a safe market. Okay, so either of those things could change if expectations don't play out, or if the other markets start looking attractive, and at some point, they will, because the valuations there are a lot lower. So if some of the overhang goes away, you could actually see that kind of a shift. So either of those things could drive some kind of a compression in the premium that India enjoys at this point.
You're reasonably optimistic about the earnings projections for FY19. So can I counter back with a very bullish argument, and this is a very bullish argument, which is that okay, valuations are rich, but when earnings recovery is about to dawn on us, valuations could be justified. And also, both of us know that when earnings recovery will happen, everyone will underestimate the demand and the earnings recovery, because earnings recovery will always surprise you. That's the nature of the market. So can this premium be justified with the fact that in 2007 we were at the peak of the earnings, now we are at the bottom of the earnings?
No, so that's a fair point. So if earnings come through, okay, and 23%, 24% is not really a small number.
Yeah, it's a very big
It's a
number.
very large number. So if it actually comes through, I think the multiple will sustain. Okay, but even then, the 70% premium is also a function, as I said, of the other part, where if the global macro improves from some of the other large emerging markets, then you could actually see a flow from here to there, because valuations clearly compared to the other markets are on the expensive side. So I think from a relative EM perspective, that's something to keep in mind. From an absolute perspective, I think that's something which we are monitoring very closely. If there is like 100% confidence that earnings are definitely going to come through or beat, then there could be some more upside to the market.
Rupee at 70, and historically even last time this happened in 2013, we almost went to 69.5. We blamed it on current account deficit and we blamed it on the fiscal deficit. This time, can we blame it on other emerging market currencies, strengthened dollar, and not our internal problems?
Yeah, I would kind of agree with that, because if you see, it's the same with most EM currencies, right? So clearly to some extent, it's more of a global thing this time. Having said that, I think the current account deficit is also on the higher side. We just raised our projections, and that's also something to keep in mind. But I would say a large part of what is happening is more because of what is happening globally rather than an India specific thing.
The flavor of the moment is clearly IT, and that's largely because TCS has added 40% in terms of market returns, $100 billion plus in terms of market cap. At a time when rupee is weak and you're not confident about macros, your house call is underweight IT. Why is that?
Yeah. So on IT services, it's been a tough sector. If I look at, say, take a slightly longer period, last 3 years, because on one hand you have seen the business slowing down, and on the other side, this year, this calendar year, it's really been in play because of the rupee depreciation. And the quantum of rupee depreciation has not been easy to call, because things have been changing, global events, and because of that, the rupee has moved from, say, 63, 64 at the start of the year to 70 today, right? And that is one of the biggest reasons why IT has underperformed. Our call on the business, which we took, say, almost 4 years back now, was that the operating profit growth in the sector will be very moderate if you look at it in constant currency terms. And that still applies. If you see the June quarter, the most recent quarter, take the large caps, okay, 5, 6 names, barring TCS, none of the other companies actually seen an acceleration in growth versus the same time last year. And TCS, as we know, they had very good deal wins in January, and to that extent, we were building it in, that acceleration will come through. But it's not really played out for anybody else. If you look at some of the companies with similar kind of models in the US, okay, the stock performance looks very, very different. And which is where I think the 2 things or 3 things I would say which have really been in play for IT. Firstly, rupee depreciation. Okay. Secondly, place to hide. Okay, as you said, volatile macro, so this is a place to hide. And third is there has been a big shift in domestic portfolios. So I would argue that a bulk of the outperformance this year has happened because domestics were really underweight going into this year. And they have really been adding, they have been getting inflows, and the portfolios have changed, the weightage of IT has gone up. So a combination of those things is resulting in this near-term outperformance, but it's at this point it doesn't look like it's the business which is driving it. It's more because of all the other reasons, and which is really difficult to take a call and say, extrapolate and say this will continue for the next 6-9 months. We are more comfortable taking a call on the business rather than on all the extraneous factors which at this point are playing a big role.
One more factor you perhaps did not mention was that buybacks are at play.
Yeah.
But if buybacks become the new norm now, that changes the way markets would be discounting these companies because the cash flow and everything changes. Can that be a differentiating factor which may perhaps make sure that IT stocks, they may not go higher, but they'll remain firm?
Yeah. So let me argue that a bit differently. Okay. So if you see buybacks is not a this year phenomenon. It was there last year, right? And yet stocks did nothing. In fact, if you go back and see some of the stock prices at which the earlier buybacks happened, they were materially lower. Look at TCS, look at any company.
Tata sold out at a lower rate. Let me put it this way.
Absolutely, right? So the point I'm trying to make, our view always has been that buybacks are good at a price, right? They are good as long as they are earnings EPS accretive. Right now, if there are buybacks happening at 20 times plus, when in India the 10-year is 8% odd, then those buybacks are not necessarily accretive. So that's one thing to keep in mind. And the second point is that buybacks, in my view, set some kind of a floor to valuations. They really don't provide a lot of upside. So it's good. And we were one of the first to write a report 3.5-4 years back saying that this is where the sector needs to move towards and the payouts have a lot of room to go up. So I'm fully supportive of that. But as I said, it's never been a catalyst. It's more of a support kind of a thing that if things go wrong, if things are tough, then at X multiple, the stocks will get supported because there is a 4% yield sitting on or 3.5% yield sitting on the stock.
In one of the reports you mentioned that there is a rotation at play and the underweight stocks are coming back. In beginning of the year, the underweight was IT, Reliance, maybe a little bit of corporate banks. So is that the game now, that the markets are rotating and underperformers will start coming back and the leaders will get into time-wise or price-wise correction?
So that's what we have seen in play through the course of this year, right? If you see start of the year, obviously IT has been a big performer.
Corporate banks haven't come back.
Yeah, corporate banks have really come back in the last month. Pharma has actually seen a nice bounce, right? So in between they had done well for a month and now in the last month again they are doing well. Cement has actually kind of come back quite nicely in the last month and a half. And then before that, you really saw quality in play. Now that was not really a sectoral play, but you could see that people were betting on really the large caps. So this is a year where, because we expect returns to be relatively muted, particularly if you're looking at dollar term returns, in that situation, I think there are still flows, but dollar term returns are not excellent. You will see a lot more rotations. So that I still think will continue. And some of the sectors which we still like going into say next 1 year is corporate banks, cement, which I still think that while they have moved up in the last month and a half, there is more room to catch up.
What is the best way to judge corporate banks? Markets are obsessed with this 3-letter word NPA, but is that the only way we should look at corporate banks?
So see, I think that's obviously important, okay, because in the last 3 years there has been a huge focus on that. And that trending in the right direction really helps the stocks. So it's important, but I think it's also important to really look at how the rest of the business is shaping up. Because say some of these banks actually have huge retail presence. If you see retail as a proportion of overall revenue, it's a very significant amount. And that part of the business is doing well, which at a point when the NPA related news flow, in some cases noise, was too high, people were just ignoring that part. So I think you'll have to look at a combination of both things, the core business, how it's doing, and the NPA issue, how kind of companies are providing for it and how things are easing out. A combination of that and valuations in some of these names are still quite attractive, particularly when you compare it to the private bank space. And that is the reason why you have seen some bit of outperformance or absolute return in the last month. And we believe some of that could continue.
So when clients ask you tough questions about leadership issues with some of these corporate banks, how do you address them?
No, so see, I think there are a couple of things. One is, if you see, if you look at the last 3 years, there has been a huge focus on that. And that trending in the right direction really helps the stocks. So it's important, but I think it's also important to really look at how the rest of the business is shaping up. Because say some of these couple of things to keep in mind. Okay, see, firstly, these are all large banks, and generally with large organizations, you will see a very good second tier or second level management team, right? So in certain cases, and again, some of the industries I have like tracked for a long time, there are times when you have been following the company, okay, but you really don't know the second and third level of management that well, because they have not really been exposed to analysts or media.
They were not the face of the company.
They were not the face of the company, but that doesn't mean that they don't have great second line or third line of management. And large companies will generally have that. Okay, so I think it's a question of how the board and is going about kind of looking at things and making some of those changes. So that's one. And secondly, I think valuations become very important, because if you are getting a good bank with a decent mix of business and things bottoming out on the NPA side at a multiple which is, say, less than half of what a good quality private banks trades at, then I think a lot of risks are in the price. So in some ways, it's always a risk reward call for us. And yes, it may be a risk, but that's a risk which, given the valuation cushion, we are okay to take.
Let's understand hospitals before you understand pharma. Hospital is where you're getting sense that the government is now intervening. From stent to kneecap operations, everything is getting under control. AAP has announced a series of price control measures which are applicable in the state of Delhi. How does one deal with that?
Yeah, okay. So maybe I'll start with hospitals. Okay, and in hospitals, while our call is again a bit of a bottom-up stock focused call, okay, and I can't talk stocks, so maybe I'll restrict it to the sector. But what had happened, say last 2-3 years, is because of something or the other, the business was getting disrupted. It could be demonetization, GST, floods in some part of the country, etc., etc. But there, and then again, as you rightly pointed out, the whole issue around capping of prices in certain areas. So all of that played out, and because of that, this space has been a big underperformer. In fact, in absolute terms, some of the stocks could be down meaningfully from the highs, and which is where our view, say maybe early in the year, was that a lot of these concerns which people have been priced in. Okay, and then some of them also had new hospitals coming up, which was also impacting profitability in a big way till last year. And our view was, as this new business scales up, your utilization on the new capacity goes up, you will start seeing your EBITDA growth being very strong, and return ratios also start moving up, and which is generally when hospitals really do well. So our view was we are getting into that cycle, and which, if you see some of the results which came out in at least in the June quarter, it does seem to suggest that yeah, things are trending in that direction, which is the reason why we went overweight on.
You don't think the asset-light business, asset-heavy businesses?
See, they were always asset-heavy businesses, right? So either you say you don't want to be in them at all, or you say that fine, this is the time when the return ratios will go up because your capacity utilization is picking up and things are normalizing. So that's a time to buy those stocks. So you can take a call. Our view is that yeah, things improving, stocks have underperformed, risk reward looks favorable. So a time to be in the sector.
So corporate banks is one space where you think things could be at an inflection point. But what about other pocket where there is a lot of confusion and you can get some clarity for our viewers? Metals. Now there is a demand push and there is a trade warfare. They both are currently coexisting. I don't know whether trade war is real or demand is real. I mean, it's a lot of confusion there.
Yeah. No, so I think it's going to be a difficult sector in my view. Okay, because firstly, the amount of news flow which comes out of China is quite significant. And on the other side, like this whole trade war issue, as you said, it's kind of something which we monitor on a daily basis, right? There is so much news flow coming out all the time, and which is the reason why the sector could be volatile. So on one hand, as you said, there are huge winter cuts expected in China from a supply point of view, which should really be supportive to prices. But on the other side, nobody knows how demand can get impacted because of this whole thing. So at this point, given the kind of volatility that we expect and risk that we expect, we have a small underweight kind of a position on it, on the sector, but we are monitoring it closely. And I don't think it's going to be really an easy call, because a lot of these things are things which will move very fast and frequently over the coming 3 months. So one will need to monitor it more closely.
But if I have to connect the dots here, The sense I'm getting is that barring corporate banks, you don't see there are too many pockets, groups or sectors where there could be an earnings surprise, which means markets, even if earnings come through, they're priced to perfection because there is no room for surprise left now.
So in some ways, that's what I started by saying, right, that 23-24% is not really a small number, right? Now, if you see corporate banks, last 3 years, they have disappointed, okay? So I really don't know if it's this year, but at some point things will normalize, okay? So you could always be positively surprised, particularly if the base is as low as say last year, particularly fourth quarter of last year, right? So I think one needs to be a bit careful, normalize those earnings, okay, because a lot of it is just a reversal of what happened last year. In other sectors, there could be pockets where there could be numbers could be better, like cement is something which we like, and again that's a sector where earnings have generally disappointed, but it does look like things are bottoming out and starting to pick up. But yeah, overall I would kind of agree with that. There are not that many sectors where you feel very comfortable that earnings could surprise meaningfully compared to the 23% aggregate which people are already penciling in.
You know, stock market investors, we both are very optimistic. We always tend to focus on the good news, kya upar jaane wala hai, where there's earnings surprise. But the other side of the equation is that where earnings could be mispriced and where prices could come down because the scope of growth is going to be limited and restricted. So where do you see there is a mismatch of valuations and mismatch of earnings, and we could be in for some hard landing?
Yeah. So again, a lot of that kind of a discussion is stock specific, okay, where there are specific names where we have concerns. I wouldn't really say that that would apply to a sector as a whole, but say a sector like say consumer staples, okay, where everybody is extremely optimistic that consumption is recovering in a big way and multiples are whatever they are. And this quarter was particularly strong, okay, but then one has to keep in mind that last year the base was obviously very bad. So in the second quarter last year is when restocking had happened. So if the second quarter doesn't look great, okay, and which could purely be because of base, the consumption trends are quite
10-12% volume growth will not sustain.
Yeah, and then if that moderates and then multiples are whatever 50 times, that could be something which might cause some kind of a reality check. IT services, as I said, if you say the earnings upgrade this year, it's all currency led. Maybe barring one odd company which we already discussed, it's all currency led, and to that those kind of earnings are always can be volatile. For whatever reason, currency reverses, IT earnings come down, and the fact that the sector has been a big beneficiary of this flight to safety and rupee kind of argument, that could also reverse. And in fact, those are the two sectors where we have underweight in our model portfolio as well.
So closing comments, are clients now engaging with conversations which are centered around 2019 mandate? Are they asking you obvious questions, the feel on the ground, or that is something markets will talk about it only in 2019? We still say 6, 7, 9 months away.
So I think before that we have the state elections, okay, which are also as crucial. So there is, like when I meet clients, there is always discussion around that. Okay, but at this point, I think people are worried about bigger EM issues. Okay, and which is why those issues, while they are discussed, I don't think the market is showing any kind of nervousness or uncertainty because of that, right? And which is what my view, and we put out a note after we met a lot of investors in Singapore, Hong Kong, where our view was that even if people, while they are talking about it, but at this point, the focus is on the global issues and where India clearly looks a safe place to be in. And that is the reason at this point, I think that's the focus. If that kind of gets resolved, etc., I think that's when we move towards some of these other issues. At this point, I don't think that's top of the mind for EM investors.
So closing comment now, final question. You know, when you talk to the long season investors who've seen cycles in India, do you get a sense that some of these investors, they're curious, they want to know, but somehow their positioning is not positioned to who's going to be the next chief minister and who's going to be the next administrator? They are here for long haul, they like earnings, and events, even if they are large in nature, they don't change their view. Do you get a sense that there are seasoned investors like this in India?
I would say there are obviously a lot of very old seasoned investors in India, right? And one of the points I mentioned earlier is people like the market. People like a bunch of stocks which are good quality, good governance, good return ratios, and decent earnings visibility kind of names. So that part of the market will always be in vogue in my view. You will always have appetite. Even say like 3 months back, I was in Europe. Okay, and Europe, usually people are more valuation sensitive and they have struggled with the Indian market. But the appetite for those 40, 50, 60 names never comes down. People always want to know what's happening here and is this a good time, etc., etc. So I think the appetite will remain. I don't think that's an issue. It's always about incremental flow, right? So that's, and I think whatever I said applies to foreign institutional investors, because domestics are getting inflows, they have to buy. They really don't have a choice at this point with the kind of inflow momentum we have seen.
Fantastic. Thank you for joining us. It's been a very engaging conversation. Thank you for your thoughts and thank you for your views. That's it on this edition of Market Makers. Thank you for tuning in and thank you for watching the show.